The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.
Welcome to Honest Money. I'm really glad that you're listening, and I'm really excited today because we're going to be talking to one of my favorite guests, Rupert Hare, who's head of multi-asset at Prescient Investment Management. Rupert, thank you so much for kind of letting us drag you out and put you in front of the screen and the microphone again.
Always a pleasure, Warren.
So this is a bit of a selfish episode, I must say, because it's something that I'm interested in, and I'm hoping that that people listening will find it interesting as well. But we're so just to sketch the scene, we're in an environment where South African investors have kind of been through the long period of time where the stock market just has not really been very rewarding. We just haven't been paid well if we've been in the JSE to get a decent return. We've had bad politics, bad economic growth, kind of big cycles that have just not been in our favor. All emerging markets, it feels like, have kind of really struggled. Our currency hasn't done well. And now we get kind of these few green shoots coming around. We've been through an election where many would argue we've kind of had a miraculous, almost changing of the guard. We've got a Wildebeest or a GNU now, a government of national unity. It seems to me, at the time of recording, that we've gone through much more now than 100 days of no load shedding, and Eskom bragging that they actually had to kind of turn some power plants off because they were generating too much. And then some news around Transnet kind of, trying to kind of, get themselves on an Eskom track of fixing themselves. I'm a little bit more skeptical about that, but I'm a natural optimist. So let's watch that space. But then I will sit in front of an investor and I'll say, it's been very rewarding, especially just to kind of buy the US stock market index. It didn't take any skill at all, and you've done very well for the last decade, especially if you measured it in South African rands. But now we've got these green shoots in South Africa, and I'm looking at the US and thinking, to my very simple view, those tech shares in America look very big, very expensive, and history tells me that when things go up for a long period of time, at some point they go down again. And equally in South Africa, we haven't been well rewarded. But telling someone to allocate any money to the JSE after a long period of not getting much return at all, often not even tracking inflation for a couple of years, it's kind of a tough sell. And so why I've dragged you back on the show, Rupert, is you head up multi-asset, which means you're not constrained to buy South African shares. You're not an SA equity manager only. You're not the guy that only can buy cash. You can look around the world. You can look at all the major asset classes, and you can allocate money to the places that you think represent good long-term returns for investors. Why on earth would you allocate kind of a rand or a dollar to the JSE?
Yeah, good. So your rand and the dollar is probably the good intro into what I'm going to come back with on that one. So I am a multi-asset investor, but there are a lot of multi-asset investors all around the world, and they're all looking for great return profiles. So picture yourself sitting in London or New York, and you've got significant holdings towards US stocks, for example, or wherever it might be, and that stock market looks pretty top heavy. And it doesn't have to be stocks, it can be bonds, it can be anything really. What they do is that they'll look on the screen and they'll say, okay, well, there's actually quite an attractive opportunity right now in South Africa, for example. There might be other cases, but right now in South Africa, we're seeing PE ratios near all-time highs, lows, not highs, that's America. And as a result, you have quite a good value case. You've got companies in South Africa which continue to earn and distribute. They've continued to grow despite the headwinds that we've seen for the past decade or so in South Africa. And I think you're right in saying that there's potentially quite a good turning point right now for growth in South Africa. So we have yet to see the results of the GNU. We wait with bated breath, but you mentioned a couple of other things which sounded quite promising. So no load shedding, improved outlook for the likes of Transnet. I'm actually quite surprised with all of these outcomes personally. Being a South African, we got quite used to having load shedding all the time. But it certainly means that there is a nice tailwind at the moment for South African asset classes. Equities is one. I mean, the value case for equities certainly exists. What they do need is a strong recovery in growth, which we're yet to see. Hopefully it comes through with the policies of the GNU. But then we've got on the other side of the coin the fixed income instruments, which are yielders and yielding pretty high yields right now with a falling inflation rate. So what that means is that you're getting in, for example, an income fund, 10.5% yield, current yield, and inflation which is coming right in below 5, which gives you CPI plus 5 in a super low risk income fund. Then you put on a bit more risk, you go into the bond space, so SA government bonds. You're getting around 13% on SA government bonds, inflation at 5, let's call it rounded to 5, and that means you're getting 8% over inflation in SA government bonds. So really, it's like we're spoiled for choice right now in asset classes in South Africa. I always will put the proviso in that we like diversification, and South Africa is one country, so we do always diversify around the world within our portfolios. But it is looking quite attractive for portfolios, especially in the Reg 28 space that have 55% onshore requirement. It's looking a lot more attractive for forward returns that we could possibly be achieving. Inflation beating returns, the most important thing.
So just for context, for someone listening, when you talk about getting 5% above inflation, that might not sound like a number, but to achieve 5% above inflation for a decade becomes a phenomenal return. And to get 8% above inflation is in a really nice stock market. If you get a stock market that delivers well for a decade, you would be really happy to get 8% a year above inflation. So to be able to buy income funds or government bonds where you're getting that range 5 to 8% above inflation, that is over time a spectacular return. And I know we get spoiled sometimes when we see some share is doubled over a year, but anything that can double in a year could just as easily halve. So when you look at something which is, and I don't want to upset you, Rupert, but when you look at something which is relatively boring, like bonds or cash, and it can give you 5 or 8% above inflation, that's as exciting as a company that sells amazing products and's got a great brand and can give you like a decade of growth, because that's what you're locking in, is basically a good few years of very good growth that will grow your money faster than inflation will erode us.
Yeah, and there's almost, so I would say, so in general investments, you get paid for taking on uncertainty. And one of the reasons why South African asset classes in the fixed income space especially are currently yielding such a high premium is that the world perceives South Africa as having a bit more uncertainty than it normally does. But we've come through an election. We've got towards what seems to be a stable government. We've got a fiscal policy which looks pretty stable. Monetary policy bringing inflation back down towards target band. Things aren't looking too bad at all. So I think that what we can do in this case is to proudly exercise some home bias and to allocate towards South African investments.
And I think that's the key. And I mean, I think just to jump back to you can see I'm naturally more inclined to shares than anything else over time. But one of the things I always kind of want people to realize is if you look at the management teams of the CEOs and management teams of companies that are listed on the JSE that have kind of operated businesses largely in South Africa for the last decade, if those businesses are still standing, those management teams are still in the job, and they're kind of growing their businesses, even if it's just in line with inflation, what you need to realize is this is Darwin at work. These are some of the fittest, toughest, most battle-tested management teams possibly in the world, in an environment that has been catastrophic to kind of, for want of a better word, for most of them. If you've been running any kind of an industrial business here where you've got to now get generators and spend millions a month on diesel and try and get your stuff to a port and out on a ship and all of that, all of the stuff that many other companies around the world wouldn't have to deal with, they would just take for granted. And you're in an environment where all of a sudden you can actually get your stuff on a truck, or even maybe even on a train one day, and you can not worry about the truck, getting stopped at not working traffic lights because there's no power, and you can actually get the stuff out, and you can almost rely on electricity for 24 hours a day. Just that, without economic growth on its own, I think is hugely helpful for some of those management teams that have just grappled with a lot. So imagine them getting some economic growth. Doesn't have to be 5% a year. That's the dream. But gee, if they just suddenly start getting 2 or 3% growth a year, some helpful government policies, maybe some helpful politicians at a national level, and you've got these super fit, super strong, super battle-tested management teams, there is reason to expect some decent returns from these businesses going forward.
Yeah, and I always see it as a circle. So those companies they benefit from growth in South Africa, but in turn they also cause growth in South Africa. So those decisions that those battle-hardened investment teams or management teams are making, that is one of the primary causes for growth in South Africa. Invest more into new divisions of the business, spend more on new geographic stores, or all those sorts of things cause growth in South Africa. So it's really a snowballing effect that we hope for, but things are looking a lot more favorable than they were certainly 5 years ago.
And I think you've made that point on previous shows, so I'll just emphasize it again. Is just neither one of us is saying now go and allocate every cent you've got only to the JSE or only to South Africa. Global diversification is important. Having a balance of assets is important. I suspect in most environments, Rupert will always have a bit more fixed income than I will, but I'll miss out sometimes and he won't. But I want to just jump to another economy, which is kind of moving. It's a major economy, and it seems to be moving in a very different cycle to the other major economies, and that's Japan. It feels to me that we don't focus a lot on Japan for some reason in South Africa. That's not, we always kind of get fixated on the US and sometimes, the UK, which is now becoming a much smaller economy as the days go by. But here you've got Japan, which is on its own a big stock market, but also a very big economy. And where every other kind of major economy is looking at, either peak interest rates or maybe starting to decline their interest rates. We've just been in an environment where the Japanese have actually raised interest rates. And the surprising thing is investors are happy about that. And I think for me that's just something to kind of to understand why is that a good thing?
The interesting thing about Japan is it's quite literally an island, right? And that's what we're seeing in this current environment where the rest of the world is looking to cut rates and Japan has started to increase rates. And I think the history of Japan is important to play into this conversation. So Japan has had disinflation, negative inflation for decades now. They've been really struggling to create inflation. And inflation, whilst we might think it is a bad thing, inflation is actually arguably quite a good thing. And this goes back to my example of companies in South Africa, because it's like a circle. So inflation can lead to growth, which can lead to inflation, can lead to growth, etc. Now, I'm not talking about Zimbabwe here. I'm talking about a healthy level of inflation.
A little bit of
for
inflation.
Example, in the United States, a little bit of it, not hyperinflation. In the United States, they target 2% inflation, and in South Africa, we target 3 to 6% currently of inflation. And why do we do that? Well, inflation can actually encourage growth in an economy, in that circle that we talk about. Japan has been struggling to get inflation on the go for many, many, many years, and they've now started to be able to, or started to experience at least some inflation. So interesting divergence from the rest of the world. They have other headwinds, like geopolitical risk in Japan, which we see a lot of. But it's a large part of the MSCI world. It's a large economy within the world. And often we as South Africans look too much towards the West and too little towards the East. So I often think we're biased towards the West. We've got Japan in the East, we've got China, we've got India as another emerging market, very strong growth cases in all of those markets. And I think there will be a big shift towards, and I'm talking about a structural shift here, towards allocating into the East in the coming decades.
I must say, I probably want to add just sort of a general emerging market, overlay to all of that. In that, if we think because we live in South Africa that it's just a JSE story or just a rand story, and I was a bit shocked the other day to see a graph of the rand against the dollar, and then emerging markets as a basket of currencies against the dollar, and it almost looks like the same movie. We kind of moved in this long, big pattern of just trending weaker and weaker and weaker. And if we're getting a major economy like India kind of, growing and growing and growing well, and I mean, I don't know what China does, but if they start to kind of resurrect their growth hopes, and other emerging markets sort of come to the party, then looking at the globe and having that very US centric view could be quite a destructive investment decision for the next decade. Not to say have no money there, but allocating money to emerging markets to Japan and then a chunk in South Africa again could be the right investment decision, but you're tilting things, right? I mean, I think it's important. I don't want to put words in your mouth. You wouldn't look at this and say, okay, I'm out of the US, I'm 55% in South African equities, 45% in Japan equities, and I'm going to borrow some money and like leverage up in South African bonds. I mean, that's not what we're talking about here.
Yeah, no, that's definitely not what we do. But I also, just coming back to your interesting example of the stocks and where they're listed, I think about it in this way quite often. Even though you're buying US equities, their revenue streams derive from all around the world. So you say you buy Apple, they don't just sell iPhones in America, they sell iPhones in China. So it's not so much a problem with the United States particularly, although you do get a lot of US exposure. What I do find, though, is that when you buy stocks or broad-based indices in the likes of Japan, generally you're getting a lot of exposure to Japan. Likewise in South Africa, despite what people do talk about when you come to rand hedges, it's primarily South Africa that drives that market. So I think interesting to always just dig a bit deeper into what you're investing in, look at the companies within the index, look at the companies you might be buying, and think, where do they make money? Is it via India? Is it via Taiwan? Is it via Japan? And then think that through in that context. It's not just about where things are listed.
Yeah, I think that's actually a powerful point. A lot of the time, we kind of look at, I always think about the Netherlands. There is a little company there that's kind of like the world's biggest monopoly in making the machines that make the very advanced machines that make microchips. And for some reason, I almost want to say like it's wrong to say it's an accident of history, but there is a kind of a dominant player in the world, and it's probably got a 10 or 15 year head start over everybody else who would like to compete. And to kind of look at that and say, well, that's a play on the Netherlands is crazy. It's a play on global tech. So I think it's a powerful point. Rupert, we're kind of coming to the end, and I just wanted to give you a chance just to kind of maybe close us out. If you're looking at this kind of multi-asset space and you're looking at the world, how do you think about it now when you kind of look at all of this and say, well, there's good news, there's bad news, there's so much going on around the world. How do you then make the kind of rational call to allocate money in all of these assets and all of these geographies?
You'll know with me, I mean, a multi-asset investor, by definition, I don't put all my eggs in one basket. It might work for the first 5 years, but then you get egg on the face. So what we try to do here is to take views, yes, but structurally, we start with a top-down. We structurally allocate towards global markets, including the United States, including emerging markets, South Africa, all around the world, across different asset classes, and to try and align that with your different investment objectives. So, if you want CPI plus 6, then take on more equity exposure, because equities have a higher premium. They get, in general, through the cycle, get paid out more. A little bit lower, CPI plus 4, less equities, more bonds. Even lower than that, take on an income fund. It's about the mix of asset classes when it comes to building wealth. It's not really about the pick of your tech manufacturer in Holland over the tech manufacturer in Hong Kong, for example. What's most important in this environment is to pick asset classes and to structure your portfolio according to your investment needs.
Thank you very much, Rupert. And this is honest money. So I have to say, if the most exciting thing that happens in your week is you looking at your investments and getting excited about them, because that's what kind of gives you an adrenaline jolt, you're doing it wrong. Investments need to be kind of very long term, very rational, and it's nice to see compounding over a decade. Doubling or halving over a day or a week or a month or a year, you're doing it wrong. That's called speculation, and it's a great way to lose money, in my opinion.
It's also the best way to lose your mind. It's far too much stress.
Yeah, exactly. Yeah. You might as well roll the dice. At least you can blame the dice then. Rupert Hare from Prescient Investment Management, thank you so much. It's been great having you on the show as always, and I'm sure we'll have you back on again.
Thanks so much for having me, Warren.
The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.